Right, so you might start off with one to reject. Which one do you reject?
Price to EBITDA.
Price of EBITDA. Price is stockholders, and EBITDA is stockholders and bondholders, something along those lines. So add ratio, something along those lines. Price to earnings, works for all companies, but not best match to this industry. Probably better, even tech doesn't usually use price to earnings. They use the EV to EBITDA more likely, but price to earnings, yeah, you can do price for earnings for every industry. No question. EV to sales ratio is fine, but best for what? Retail stocks, retail. So it's fine. Price to book ratio is fine, and best match for high cap total industry. So yeah, FedEx, I gave it away. I said I have a high property, plant, equipment. And you see high property, plant, equipment, price to book is your most likely one to use. All right. So pretty straightforward question. We'll see if this class. Yeah, on the exam, this is the most missed question, even more than the option one. So you have the exam guide is out on Canvas. You have 2 exams to practice from. So why the entire class doesn't make 100 on this exam, I will never understand. And there's even students that bomb this exam. I don't understand that. Some students say it's so much to memorize, but there's nothing on the exam to memorize because everything in the exam is what? Stuff you know as a finance major. There's not a single thing on exam you shouldn't know off the top of your head as a finance major. So it's like me asking me name your family members. It's like, wait, that's a lot to memorize. No, you just know certain stuff, right? That's a human being. You just know stuff. So yeah, I don't understand it, but we'll see how y'all do. Okay, so real quick, here's a paper 3-4 example. They did Texas Instruments. They started off explaining the company up front. You can do that. This is a little wordy for abstract, but they did that. They did the discount rate. They followed very much the video. What's the risk-free rate? They showed, it's not bad to show the history of the treasury. Market risk premium. They did the charts I gave y'all from class using the implied approach. Then beta, revenue analysis, financial leverage, operating leverage, the historical beta. You got to do this chart in your paper. And then the final recommendation. I do recommend you have some kind of chart that brings it together just to make sure you've included all those. Then on the valuation, he gives the assumptions up front. You can certainly do that. And then he justifies each one of those. Gives the growth rates, the inflation. And then I really like this on the formulas. He gives the formula and then he gives his numbers. Because if you don't give me the actual formula, I can't tell some student, I can't even get their number because I plug in all your numbers and I should get exactly your answer. If I can't get your answer, I don't know if it's because there's a formula error or you're inputting the wrong thing. Some students, my discount rate's 941, and then they give me the formula and their discount rate suddenly 737. And I don't know why. Why would discount rate? So there's confusing things that happen, but I can't figure that out because I don't have the numbers for the formula. So you might not do this in an actual paper, but for me it helps because it lets me know why there's an error and I can try to figure that out. And then remember, you have to have at the very end. So he does the 3 models. Then the very end, you have to have a buy, hold, or sell. I don't know if I would title this buy, hold. I would probably say what I'm doing. Recommend buy, recommend hold. Make the title more explicit. He has all the output. So he follows that video just precisely. Some students were asking, should it be 1 file or 2 files? Just make it 1 file. There's no reason to make it 2, especially if you're going to put it on LinkedIn. This is all really one big paper. So pretty straightforward.
That example you posted.
No, I don't post on these, because some students I would get exactly that paper for their paper. So there's too much, especially paper 3, there's too much overlap. All right. So now we're getting to my favorite topic, derivatives. You've probably heard the word derivative. So a derivative is a security that you can't do discounted cash flow for. You don't know the value of the security without knowing the security it's referencing. So these are securities that derive their value from something else. It can be another security, it can be a benchmark, it can be an index. That's known as the underlying. So a call option on Apple, call option is the derivative, Apple is the underlying stock that you get your value off of. There's two types. There's only two types. There's options and futures. Options include swaptions. If you take my risk management class, we'll talk about swaptions and swaps. Your auto insurance is an option. Your right to prepay your mortgage early is an option. An option gives the buyer the right to do something at some future stated price. So auto insurance. You have the option to sell your car to your insurance company at its adjusted cash value. And when would you do that? Right after you wrecked it. So you probably wouldn't sell it. You can't really. You have to have a wreck to get it. You have to have some accident. But if you total your car, you have the right to sell that car back to the insurance company at the cash value. It's kind of a nice option to have. You have the right to pay off your mortgage anytime you want to at the par value of the mortgage. That's kind of a nice thing to do. When would you do that? Well, when interest rates fall a bunch, you pay it off, reborrow at the lower rate. We won't talk about swaptions here. Swaps is my favorite derivative of all. I love swaps. But a swap is not an option. A swap is a future. But a swaption is an option to enter into a swap. Even more spectacular. It's just amazing. So options give you the right to do something, but you're not required to do it. A future obligates you to do something. You have to do it. An option has a price. A future is free. When you enter into a future, there's no cost, zero. The first swaps I did at UTSA, the accounting department wasn't sure what to do because we entered a swap. It had a notional amount of like $3 billion. And they're like, what do we do? There's no price. We can't, what do you enter where there's zero? What journal entry do you do? Well, a few years later, the thing was worth 500 million bucks. So now obviously you got to make some entry, right? You got something that's worth 500 million bucks. So they're like, how do we do this? And I was like, go look it up. It's a FASB 133, right? You got to go look up FAS 133. One thing that bothers me about undergraduate accounting for finance majors is they don't cover the most important FASBs. 133, 120, there's a lot of FASBs you should be covering. I could give you a list of them that you really should research. If you interview with an investment firm, you better know held to maturity. You better understand the 3 levels, but they don't cover that in accounting anywhere. And they really, really should. They should have a special accounting class for finance majors because it's key. That was huge in 2008, the held to maturity. Silicon Valley Bank just went under because of held to maturity rules. But derivatives have their own special rules, and the accounting for derivatives, that's FAS 133. How do you account for these things? That's really, really important. If you're going to enter, I had to study this with UTSA. Fortunately, UTSA had just hired an accountant that knew these things backwards and forwards. And so I sat with him and he said, okay, bottom line, here's what's going to happen. Can you live with that? And I said, yeah, I can live with that. And he said, fine. It was a 10-minute conversation. If he hadn't been there, it would have been hours and hours and hours of research. So the accounting for these are quite difficult. Options and futures are very differently accounted for. Futures are really strange because that zero upfront cost. The accountants are like, you didn't do anything. They say, no, I absolutely did something. You'll find out about it tomorrow because these things are going to move in value quite dramatically. All right. So options give you the right to do something. Futures obligate you to do something. There's something called the notional value. So I love this website. So this website shows you values. So if you looked at all the silver in the world, it's about $44 billion. Cryptocurrency, about 240. I don't know when they updated this thing. I think it's somewhat. 3 years ago. All right. So it's a little somewhat current. Who knows what crypto is today versus then. Military spending, US government deficit, coins and currencies, the Fed's balance sheet, $7 trillion. If you added up all the trillionaires, all the billionaires in the world, they have $8 billion. Gold is 10.9 trillion. That's one thing. It's hard to know exactly how large the US debt is because we don't have a balance sheet. I wish the US government had a balance sheet because they have a lot of gold. They also own a lot of property. So it's hard to know. We say we have $30 trillion deficit, but how much gold does US own? There's $11 trillion in gold out there. They own a lot of it. And why do you think the US property value is? Have you ever looked at a map in the West United States? What percentage the US government owns? That's got to be true. So who knows what our balance sheet looks like? But then they have $30 trillion in unfunded Medicare and 10 trillion unfunded, so who knows what our true balance sheet is. But we do have a lot of gold, but 11 trillion in gold. If you added up all the Fortune 5,000 companies, that's what they add up to. Then you add up all the stocks, that's 89 trillion. Money supply is 96 trillion. Global government debt is $253 trillion. Global real estate is huge. So that's one of the biggest assets out there, 281 trillion, much bigger than the US stock market. Global wealth, $361 trillion. Most of that's real estate, as you can see. Okay, now derivatives. So the global economy or global whatever, global wealth is $361 trillion. Derivatives have a market value of 12 trillion, but what is the notional value of derivatives? It's $559 trillion. It's bigger than everything else. How can that possibly be true? And so you can see the picture of notional amount. So that's notional value. That's the low end estimate because we don't actually know, but it could be $1 quadrillion sitting in notional amount in derivatives. The press loves to quote that number because it's so massive. But should we be worried about that number? $1 quadrillion. When you take my risk management class, you're going to notice that number doesn't really matter all that much, but it is a huge number. But if you buy options on $5 million worth of Apple, your option market value may only be $10,000, $20,000, but your notional is $5 million. So it's what you're based off of. It is an important number, but it can be really, really exaggerated. So notional amount is your actual exposure, what you're actually exposed to. Let me just give you an example. I love to do interest rate swaps. I can do an interest rate swap with a duration of 5 years, and then I might need $1 billion, or I might do a duration of 10 years, then I only need $500 million. The notional is either $1 billion or $500 million. It depends on whether I do 5 or 10 year duration. So you can see how that notional amount is all over the place. I can double it or shrink it depending on what kind of exposure I have. But the notional amount is what's going to define how your derivative moves. All right. It explains your exposure. It is not the market value. Remember, the derivative I bought had a 0 market value, but the notional value is $3 billion. The $3 billion tells me how much that thing's going to move. So if I have a market value of 0, but a notional value of 3 billion, and the 3 billion moves up 10%, essentially I have a $300 million gain. So it's going to define my gain or loss. So if you buy 1 million S&P 500 futures, your market value is 0, but if that rises 10%, your market value goes from 0 to 100,000 bucks, right? Because 10% of a million. So it's as if you own $1 million in S&P 500. but the market value is only 0. But as the S&P moves up and down, your market value is going to go up as if you had $1 million in the S&P. So you see the notional is very, very important. It explains your risk, but you can manipulate it pretty dramatically. So the actual outstanding 1 quadrillion doesn't really tell you much. And it also on a swap, I might be long a $3 billion. Someone else is short $3 billion. They count that as $6 billion. But my gain is going to be his loss. So they offset each other exactly. So it's not quite the same as their asset. So notional is very, very tough to talk about. You got to get used to how to use it because it's an important number to understand, but it's a little bit of an exaggerated number. We really don't know the number because most derivatives, well, a lot of derivatives are over the counter. We don't know the actual amounts because it's between 2 parties. So it's tough to know. The underlying is whatever that notional is based on. It can be a specific stock, it can be the S&P 500 index, it can be commodities. You can do futures on oil prices. It can be interest rates. You got to be real careful with interest rates because you got to make sure you're going the right direction. There are derivatives on inflation. They're very small, very illiquid. We actually looked at this when we're at UTSA, and there were some CPI derivatives, but they were way too small for us. We couldn't have used them. Currencies is maybe the biggest one. Everybody does currencies, currency futures to hedge your risk. They're weather derivatives. Y'all know there's actually swap contracts where Disney and a farmer can enter a swap. And Disney says, if it rains a bunch, we're not going to make much money. The farmer says, if we have a drought, we're not going to do very well. And Disney says, I'll tell you what, if there's a drought, we'll pay you $1 million. If it rains a lot, you pay us $1 million. And the farmer says, that's fine. If it rains a lot, we're going to make a lot of money. If there's a drought, you send us. That seems crazy, but that's exactly what these are. Catastrophes, UTSA, the first catastrophe bond, you should look that up. So I'm pretty proud of that. UTSA developed the first catastrophe bond. Can you imagine a catastrophe bond? Those are, none of you took my P&C class, but some of you are taking my P&C class. We'll talk about cat bonds. That's where, if there's no catastrophes, the bond manager makes a lot of money. If there's a catastrophe, they got to pay the insurance company a lot of money. So no catastrophes, you make 8%. If you have a catastrophe, you got to know how big that catastrophe is. If it's $900 million, you still make 8%. If it's 1.3 billion, you lose all your money. So you can imagine how nervous people get when there's a hurricane out there in the Gulf. Life insurance, there have been life insurance, social impact bonds. Those are pretty cool. That's where a city says, we're going to spend $10 million on this new prison program. We think it's going to work, but we're not sure. So the bondholders say, you know what? If it works, you pay us 9%. If it doesn't work, you pay us 6%. The city says, okay, well, if it works, we don't have to have as many jail cells. There's not as much crime, so we can afford to pay you 9%. If it doesn't work, that's bad. We wasted money, but at least we don't have to pay you 9%. We have to pay you 6%. So these are some things we talk about structured debt. These are some things where finance has got it really creative. I think sometimes it's really good. Weather securities are pretty interesting things. Cat bonds, UTSA, boy, that was a really good product for them. So we've gotten creative. You can really get pretty creative. There's a book I love, but I can't remember the name of it. But it's a guy, his career was to develop new one of these. And he has several chapters of when does a derivative work and when does it not work. And it was very, very fascinating. If I can find it, I'll put it on my reading list, but I read it years ago and I can't remember what the name of it is. But it's a really, really good book. So that's notional value and underlying. Okay, I'm frozen. Where can you go to get more resources here on this? I love CBOE. I just think it's wonderful. Great website. And they have an education button. So you can do that. Now, if you do the Bloomberg Market Concepts, they have a derivatives section that you can do. Any of y'all done that yet? You're starting now. Have you gotten to derivatives yet? Have you done derivatives yet?
No.
Yeah, they do a good job on these as well. But this is really, really good. It's written, they're done not for the general public. They're really done for they're a little more advanced. The Khan Academy has a good derivatives. I was really surprised. It really amazes me what Khan Academy does. That guy, he teaches everything. He's doing, Renaissance art, and he's doing stock options. It's a pretty amazing guy. But yeah, these are really, really good tutorials. I think there's videos that you can watch. So really, really good options course. I don't know if they have credentialing, like if you take the course and if you can put it on your resume, but really, really good resource. Like I mentioned, Khan Academy. One thing I love about Khan Academy is his videos are like 5 minutes long. He doesn't, you can watch 3 or 4 of them and go and do something and come back, but he does a good job. Options strategies, options as an investment strategy. That's a book. A lot of my students recommend. I haven't read it yet, but that's a good one. It's in the class notes. Trading on Corporate Earnings is a book I really, really like. I do highly recommend that one. I don't know if I can get into it. I don't have it linked here. Trading on Corporate Earnings. It's a short book. It's very well written. They're talking about straddles. We'll talk about straddles and doing straddles around earnings announcement days. But since you've done paper 2, this would be a great book to read because they're talking about how to do option strategies when the firm is announcing earnings and how to use historical vol or some other things. It's not a long book. I think it's not even 200 pages long. 225 pages. So very well written, very easy book to read through. A friend of mine who's a high school choir director, she on Facebook was asking for book recommendations, so I gave her this one. She was like, yeah, I'm not going to read that. But other people, normal people wouldn't read it, but it's a really good book. The option guide is useful. iTunes has some really good podcasts on options. There's places you can go. There are plenty of places to go to get more research. One of our students in the investment society, it was interesting. This was a pre-med student, and he started attending the investment society, and then he dropped out of pre-med and became a finance major. And he taught our options class for the investment society. He's now an option trader in Chicago. I saw him this last summer. He's doing great. I've gotten him to speak to some of our classes. Really sharp guy. So, we've got some pretty good contacts. You could make your whole career derivatives. It could work. You can make your whole career futures on pork belly futures. I mean, you could make it very specific career. There's a lot of complexity here that you can learn. My favorite story is a student I had. I may have told you all this story, but he went, I think, to Dubai. I've told you all this story. He shows up first day of work. He's going to be their backup option trader. They're going to train him. He shows up, and the option trader had quit that day, and they didn't hire a replacement. And they said, this is now your job. Would you like that your first day on the job right out of school? And I saw him 3 months later, the cockiest kid, man, my word, he figured it out. He was so proud of himself, and I was really impressed. That's pretty scary. If I were he, I probably would have just gotten I don't know what a Rolodex is, but I would have just gotten the Rolodex for the guy before me. I would have called somebody and said, this guy just quit. I'm the newbie. I don't know what he was doing. I'll give you every one of my trades if you'll train me how to do this. That's what I would have done. I would have found a name I'd recognize, like JP Morgan, call that guy JP Morgan and said, show me what to do. You'll get all my trades for the next 12 months. That's what I would have tried to do. But I haven't heard from that guy in a while. I wish I could find him again because I would really want to know his story. That was his career. He was an option trader, kind of unintended there as the lead trader on a firm on his first day out of school. So let's talk futures first. I hate futures. I don't do futures. My brain doesn't think futures. I'm a swaps guy. I love swaps. Swaps and futures are essentially the same thing, but I love swaps. They make perfect sense to me. I hate futures. When I took the C of A exam on part 2, they gave us one book that we had to read. It was maybe 110 pages long. The entire book was nothing more than proving mathematically that swaps and futures are the same security. That was the entire book. They didn't ask a single question on the exam. I read that book in so much detail. They didn't ask any questions on it, but I love that book. Really interesting book. So future obligates you to do something. So if you're long on a future, you're bullish on the underlying. So if you're long on the S&P 500 futures, you're long on the S&P 500, you're hoping that it's going up. This is where you got to be real careful on futures on bonds. If you're long on a treasury future, you're hoping treasury prices go up. So you're hoping interest rates do what? Fall, right? So you gotta be real careful. Don't think you're long on treasury futures hoping treasury yields are going to go up, because you're going to be really surprised. So we're talking about prices. So the underlying is a treasury price. You're hoping, if you're long on treasury futures, you're hoping interest rates fall. If you're short, you're bearish on the underlying assets. So if you're short on S&P 500 futures, you're hoping the S&P 500 falls, all right? Or the interest rates rise if you're doing bonds. FinViz does a pretty good job. So you go into FinViz. Market looks a little red today, but it's pretty flat today. But they have a futures button, and they cover most of the major futures. So obviously there's futures on stock markets. There's futures on the VIX, which is interesting, something I've never done. There's options on the VIX. We'll have to talk about that. That to me is the most bizarre thing. If you buy call options on the VIX is the underlying standard deviation of the option mark. You know, it's like my brain, I'd have to sit down and write it out. You have options on energy, oil, you got Brent, and you have WTI. Look how different those prices are. That's pretty amazing. You have futures on gasoline, on heating oil, on natural gas, ethanol. You have futures on agriculture, cocoa, cotton, orange juice, coffee, which is the one I follow. Coffee's been doing some strange things here recently. Lumber, we talked about lumber earlier. Sugar. You have soybeans. You could make soybeans your entire career, because we saw a big thing blow up a few years ago, right? When Trump started battling with China, and which was kind of interesting. The first president willing to take China on. People are like, you can't do that. Everybody was in the background saying, I'm glad he's doing it, but I'm not going to say anything public about it, because, you know, China does some stuff that it's probably not good for global trade. But whether Trump won that battle or not, who knows? But what did China do? That's fine. We'll just stop buying soybeans for the United States. Well, what did that do to soybean prices? You can just imagine. Huge, right? You'd be following that. You have corn. These are heavy U.S. and Ukraine and Russian crops. Rough rice. I don't know who does rough rice, and I don't know why it's rough, but oats, canola. So you have a lot of agriculture. You have the metals, gold, silver, platinum, copper. They're very, very interesting, because gold is a precious metal. Copper is not a precious metal. It's an industrial metal. And silver is in between. Silver is a precious metal and an industrial metal. So you have a lot of forces going on there. Palladium, I'm not even sure what palladium is. Is it palladium? Do you wear palladium, or is that what is palladium? What does palladium look like? Y'all know? Lady, it's a movie theater. So it must be really, really nice. Is that a precious metal? It's a chemical element. Atom 46. I have no idea. Why would you buy palladium? What do you use it for? So you become somewhat an expert, right? On stuff that no one else knows anything about. And so that makes you very hireable.
Yeah.
It's what? Well, what did I use it for 40 years ago? So is it recent metal? So I don't know. Live cattle. We do a lot of cattle in Costa Rica. Very interesting. There's one lady in our micro lending. Her name's China. She's such a good businesswoman. She puts me to shame because she takes me to her farm, which is essentially on a cliff, and she's in floppies, just in sandals, and I'm in boots, and I'm crawling on all fours, and she's just walking like she's Spider-Woman. But she buys 5 cows and she fattens them up. She sells 4, pays off the loan, and she makes a cow every time she does it. And she's really good at it. Her son's really good at it. But I don't know how exposed she is to this market. I think she's a very local market, so it'd be interesting to see. But she buys the cows really thin from the indigenous area, and then she fattens them up and she sells them. It's, that's a whole field of finance by itself. Lean hogs, which that's been a big issue, right? Because you've been seeing the China having to kill a bunch of their pigs because of the whatever the bacteria or virus, whatever went around. So each one of them have their own world, their own drivers of value. So today oats are up 3.1%. And lean hogs are down 3%. I thought Thanksgiving's in 2 days. Wouldn't lean hogs be up? I don't know. How many of y'all having turkey versus ham for Thanksgiving? I hate both of those, so I'm not having either one. I want to have mac and cheese, and everybody wants to have turkey. So it's like, give me something a little more interesting. So why are these up or down? You can see you can make this your entire career. So, and how do you make it your own career? You don't say, I'm going to be a lean hog trader. You get offered a job and they ask you, hey, do you want to move over to the trade desk on lean hogs? And what do you say? You always say yes. That sounds really scary. That's how you know you're going to say yes, because it sounds really scary, right? Victory Capital is looking for someone for their trade desk. And I say, oh, that's a scary job. You got to do it. Great job. Anytime you can do a trade desk, you got to do it. If you work for Valero and they ask you, hey, you want to go over to the trade desk? Yes. You don't even think about it. Yes, I'm moving over there right now. There's a guy who worked for me when he started off in the kind of an intern job at kind of an access program. A great employee. I didn't want to lose him, but he got offered to do USA's security lending, or not securities, securitization program. And he goes, man, Ron, I don't want to leave. This is a great job. And I said, you got to go. You got to go do that. He says, yeah, but I don't leave. But very complicated. He became the fastest senior vice president at USAA in history. And he took that job. If you go there, you probably know who I'm talking about, right? So you got to do it, right? You got to just jump in the deep end and do it. So this gives you a lot of opportunities because each one of these is a specialized area. You don't pick it now, but if you get a chance to pick it, you go for it. And then it may just be you're getting paid $3.2 million to do something that you think is really easy, but no one else has a clue what you're doing. That's like the perfect job, isn't it? It's stressful. There's times where it's stressful. The lean hog guys today are probably stressing out a little bit, but that's all right. That's their job. So, yeah, so FinViz does a good job. It gets you a lot of history. I don't want to go into this too much, but just real quickly to understand contango and backwardization. A barrel oil, let's say the spot price is $100. What does spot price mean? You can pick up the phone, buy a barrel oil. You pay $100 a day and you get a barrel oil today. That's what the spot price is. The futures price is what you have to say you're going to pay in 3 months. So the futures price might be 102. You can buy oil today for 100, or you enter a contract to promise to pay it 102 in the future. Now, I've heard students say, and I've seen this in economist articles, the futures markets is expecting oil prices to rise. And that's absolutely wrong. If everybody thinks oil prices are going to rise in 3 months, guess what they do today? They rise today, right? It's not like, oh man, oil prices are going to go up. Boy, I got to sell this oil for $100 a day, but it's going to go up to 102. Well, no, you just don't sell it today. You wait. So what is that 102? Well, it should be what we call cost of carry. Because you could buy oil for $100 a day, store it in your backyard, and sell it in the futures market for 102, you make $2. But what if it costs you $2 to store it in your backyard? What have you gained? Nothing. You buy the oil for 100, costs you $2 to store it, you sell it for 102, you broke even. What if you could store it for 25 cents? What would you do? You buy 1,000 barrels of oil, $100, you put it in your backyard, you cost you 25 cents per barrel to store it, you make $1.75. That's pretty good. How many barrels would you do? How much space you have in your backyard?
Yeah.
Right? Pretty easy to do. What if it costs you $3 to store it? What would you do? You wouldn't do it. It wouldn't make sense, right? So that's what cost of carry. Cost of carry has two parts of it. One of them is storage. The other is time value money, because if you buy the oil today for $100, you're out there $100. You're losing interest. If you do the futures, remember that's zero. You don't have to pay anything. So then you say that. So if you do a futures on the S&P 500, the only cost of carry should be the time value money. You could buy $1 million of S&P today, or you promise to buy the S&P in the future. The only difference in those two should be that time value money. If it's not, you can set up an arbitrage trade and make a lot of money. All right. So cost of carry should be the only difference. So here, the futures is 102. You can buy for 100. It costs you $1.50 to store it. 50 cents in time value, you're indifferent. There's no reason to do that trade. What if, and that's the normal, right? That's called contango, where the futures price is higher than the spot price. That's contango. What if the future price was 98 and the spot price was 100? That's called backwardation. You would think that would never happen, right? Because then you could short the oil today for $100 and teach a futures contract for 98. You'd have a $2 price. But how do you short 100 barrels of oil today? I can do that with Apple stock, can I? I can sell Apple stock today, even though I don't own it. But how do you short 100 barrels of oil today? If you sell someone 100 barrels of oil today, what are they going to want today? They're going 100 barrels of oil. How do you sell 100 barrels of oil that you don't own? So can you short oil? You can't. Can you short your neighbor's house? You can't. You can short stocks, you can short bonds. So there's no way to do an arbitrage trade with backwardation. It's just not possible. So yeah, you might say, well, that's great. I can sell oil today for 100, enter a futures market to buy it back at 98. And I got a sure deal of $2, but there's no way to set that up. Do oil prices trade in backwardation? Yes, they do. If you take my risk class, we'll talk about that. We'll do a really famous case on that, where a firm went insolvent because of this, what happened with backwardation. It shouldn't happen with S&P 500, but it can happen with these actual physical goods that you can't set up an arbitrage trade. And there's a lot of debate about why that happens. Y'all probably heard in 2020 where futures prices went negative. Did y'all remember that? Pretty wild. Why was that? Because there was no place to store oil. So you might promise to buy the oil, but they're going to say, great, you're buying the oil in the future. You tell us where we're going to store it, because there's no space left anywhere to store oil. It was just overflowing. You say, well, I'll just leave it in the tanker. The tankers are like, no, we're all sitting out here in the ocean with full vessels. There's, unless you've got a big swimming pool, this is not going to work. That was pretty wild. People were asking, how can I make money off of this? And they couldn't figure out how to do it because of that storage issue. So markets don't give you this free stuff. Just there's something going on, you better research it. But yeah, there was a time in 2020 where the futures price was actually negative. It just seems absolutely crazy. But backwardation, I'm not an expert in futures. I hate them, so I can't tell you about these kind of things, but they do happen. You work for Valero, right, Kevin? Did they talk about backwardation where you were there?
Yeah, we covered all this.
You did? Really?
Yeah.
Ah.
Go backwardation.
I think you should do this part of the class.
Oh, no.
It's pretty complicated stuff, isn't it? But those traders could tell you off the top of it, and they probably drain backwardation. So yeah, it's interesting stuff. I remember talking to an oil trader, and a futures trader, and I said, "What's your view on the oil markets?" "Oh, I don't know that. I don't really cover that." It's like, what? It's like his whole thing was trading off of contango and backwardation. He knew the mathematics of it, but he didn't care about supply and demand and all that. He was like, "Yeah, I don't really have a view on oil prices." Like, how could you not have a view on oil prices? All right, I'm not going to cover the rest of this, so you can read the notes. It just shows you how you do this. Now, if you do futures, you do a futures contract. Let's say you have a futures contract where you guarantee you're going to buy 1,000 barrels of oil 3 months from now. You better get out of that contract in 3 months, because if you don't, 1,000 barrel of oil are going to show up on your doorstep. All right. So what do? You can do this transaction. Most people don't actually do delivery. So what you're going to do, enter this transaction. You're offering to buy oil for 102. If in 3 months oil is trading for 120, you have a big gain. So what do? You buy that oil price, that futures back. It's going to be at a huge loss. So you buy back, you have a huge gain. So you make your money off of futures by exiting the contract right before expiration. So you don't have to worry about the delivery. All right. I'm pretty sure you won't forget, because your broker's probably panicking. It's like, you're going to get out of this contract. So it just shows you how you do this kind of trading. So if you want to do 1,000 barrels of oil on futures, you can do it. It's really not that difficult. You have to put up some margin in the background to make sure you have that to cover, but that's how futures work. I think swaps are much better, much easier to understand, but we're not going to cover swaps in this class. Futures are exchange traded. They're very, very liquid. Forwards are over the counter, and swaps are a forward. Swaps are over the counter. So they're not publicly traded, not as liquid. You have a contract. The contracts are ridiculous. I covered the contract in my risk class. They're just ridiculously written contracts. I remember when the first swap I did, I read the contract and I said, "This makes no sense to me." I went to my lawyer. He says, "I've never done a swap, but we have a firm that specializes in swaps." So he brought them in, these two lawyers. And I said, "What does this paragraph mean? I've read it like 1,000,000 times." And they said, "We don't know what that means." And so I said, "That's great. You're the experts." And so I had to finally said, "This is what I want. When this happens, I want to be able to do that. Does this contract say that?" And they said, "Yes, it does." And I said, "Okay." I looked at my lawyer. "Do you trust them?" And he said, "Yes." Very complicated transactions. So futures and forwards, you can kind of name your own terms a little better. With futures, the market tells you the strike prices, that tells you the maturity dates. That's all spelled out. So you don't have much flexibility. With swaps, the swaps I did, my traders said, "Hey, we can do a 30-year zero swap for you, so you don't have to worry about settle." And I said, "Great, let's do it." It's like, that's pretty cool. So yeah, you can do some pretty interesting things when you're on the forward side. Do y'all know swaps? Have y'all covered swaps yet? I know Catapacum covers them a little bit. Have you covered it in the class, undergraduate?
I think I'm doing it today, but also in international finance.
Okay. Catapacum does it differently than I do. So you might, in my risk class, see it's a little bit different. He does it kind of mathematically. I do it the way the transaction actually looked to me, which is, so you'll see how I saw the transaction. He shows you how the textbook shows it. He kind of implies that there's this arbitrage that keeps it from getting out of whack, but there's actually a swaps curve. There's a treasury curve, there's a swaps curve. So I covered a swaps curve, so it's a little bit different. But anyway, that's the biggest transaction I did at USA. Bought it for zero, and it went up to 500 million bucks. That's a pretty good return. You can do the holding period return on that. 500 million divided by zero, you can kind of figure out that return. It's pretty high return. All right, let's do even my more favorite, which is options. We did a lot of options at USA. Pretty cool stuff. So call options, put options. Which one's bullish? Call options. So you do a call option when you think the security underline's going up. You do a put option when you think the underline's going down. So it gives you the right to buy or sell something, buy if it's a call, sell something if it's a put in the future at some expiration date, at some stated price, we call it the strike price. So you got expiration and strike price. Does the right to do something have value? So let's look at this. I usually get the wrong answer first, but let's see if y'all can do that. So let's look at Apple. Apple's trading for 190. If I gave you the right to buy Apple for $210, would that be of any value to you? Would you pay me money? You can buy for 190 right now. Would you pay me money for the right to buy for $210? And what's the answer? It sounds like a no. Next 3 months. Would you pay me money? So 3 months is what? December, January, February. Let's go out to March, next 4 months. How much would you pay me to have the right to buy Apple for $210 between now and March? Would you pay me 3 cents, 40 cents, $1? Well, let's look. What did I say? $1, $2.10. So why is it blue? Oh, well, 210. Sorry, I was looking at 110. So why is that blue? Well, it's actually over $2. Why would you pay me $2 for the right? What happens if Apple was trading at $200? What would this option be worth in March? You have the right to buy for 210, but you can buy for 200. What would you do? 200. What would you do? You just let it expire. But what if Apple's trading for 250? That's pretty good, isn't it? You can buy for 210, turn right around and turn it for 250. You made $40 minus $2. You made $48 on a $2 investment. That sounds like a pretty, it's not good as my swap. It still sounds like a pretty good investment, right? You made $40 and you invested 2, or you made $38, you invested 2. That's pretty good. It's down 13% today. Why is that? Probably because Apple stock is down today. So what about the right to sell Apple for 170? Would that be worth anything over the next 4 months? How much would you pay for that? I'm kind of parallel. Would that be $2 or would it cost more? I'll charge you $2 to be $20 worth the current price. How much would I charge you to sell it $20 below the current price? Let's look at that. Did I go too far? Or 170? Excuse me. Sorry, I keep forgetting my numbers. It's about the same. About $2. So what's the finding? How do we know that $2? Is that a good number, do you think? Or is the market just making stuff up? So in the 60s, we didn't know. And then something happened in the 70s. 2 guys came around in the 70s. And what did they do? You know their names? Black and Scholes. And what did they come up with? Option pricing model is probably the fastest dissertation paper to hit the markets in history. Right after they published their papers, Texas Instruments came up with a calculator to do their calculation. So good old Black-Scholes. And it's a really simple formula. It's not that complicated a formula. I memorized it for the C of A exams. I don't have it memorized now, but I had it memorized for the C of A exam. So here's the formula. And you'll notice there's like 6 things in it that you need to know. But you can do this I did this in Excel. It's pretty easy to set up in Excel. It's nothing more than using exactly what you did in statistics with the normal curve and standard deviations. That's all it is. It's pretty straightforward. Essentially what they're saying, the price of an option is looking at where the stock price is now, what the strike price is, the standard deviation of the stock. And it's essentially asking, what's the probability Apple's going to be above 220 in the next 4 months? Pretty simple stuff, right? So let's see if y'all can figure these things out. What is S of T? What is S? Is it the 190 or the 220? That's the 190. That's the stock price. All right. Do you bowl or you play baseball? What is the K? If you play baseball, it's a K. If you bowl, it's an X. So what is the K? Strike price. Okay. I use an X. They use a K. So they must be baseball players. So notice what they're doing. They're doing the 190 divided by the 220 or the 210, whatever I said. And they're doing the kind of the log normal of that. What do you think the T is? What is T always? Time, right? What is the R? What is R always? Interest rates. What is sigma always? Yeah, sigma squared is variance, but standard deviation. All right, so essentially, they're trying to figure out what's the probability this K is going to go above that S, or it's going to be higher, all right, using these inputs. So that's the call formula, and the put formula is very, very similar, but it's not a difficult formula. I'm glad I had it memorized on the exam for the CFA exam. Part 2, they did an option problem, but it was a Ginnie Mae mortgage-backed security. What do we say about Ginnie Mae mortgage-backed security? It's a bond with a call option. You remember that? Bond selling a call option. So I used option pricing theory to answer that question. So I was glad I had that formula memorized. But you could easily get, in fact, this would be probably a cool thing for you to try to do. Try to put this into Excel and see how close you can get to the option prices that are actually trading. Find a stock that's not paying dividends. That takes out one of the factors that's hard to the model. So find a stock like Alphabet or someone that's not paying a dividend and put all the pieces in, and it's not that difficult to put these pieces in. I did it at UTSA because we had employees coming. UTSA is trying to hire these employees that were coming from publicly traded companies where they had stock options. We're trying to show them what the value of that stock option is so that we could kind of try to buy them out. So they needed an option pricing model. So I used Black-Scholes. So yeah, the right to do something does have value, even if it's even if it's overpriced, 220 versus 190 or 210 versus 190. It depends on the probability that thing's going to move above that particular price. Now, what if I gave you that option and it expired this Friday to buy Apple for 210? What would that be worth? Probably less than a penny. If someone gave you those options, would you take them for free? It's possible something wild could happen with Apple in the next few days. What if Apple was announcing earnings tomorrow? Be a little more valuable, wouldn't it? So what did we say one of the inputs in that model was? Standard deviation, volatility, right? That's an important one to it. Options are positively skewed distribution. The most you can lose is the $2 you paid for it. You could make 40, 50 bucks. So it has a lot of positive. All right, so this is that option pricing model. These are the things that determine the value of an option. Texas video, TXSVID. What's the T for? T is not for Texas. It's not for taxes this time. This time it's for time. X, strike, because we're bowlers. Some of y'all probably never bowled in your life. So anyway, S, stock price is the underlying. V, volatility or standard deviation. I, interest rates, and D is dividends. That's the one we're not going to include. So that's it. So someone asks you, what determines the value of an option? Well, when does it expire? Does it expire in 3 months or in 6 months? What's the strike price? Is it 210 or is it 200? What's the price of the underlying? Is it 190 or something else? What's the volatility of Apple's stock? Is it 30%? Is it 20%? And that's the actual volatility of the stock. Real simple. You just take the percentage change in Apple stock and you just take the standard deviation of that, and that gives you that V. I, what are interest rates? If the T is 3 months, then what's the risk-free rate over the next 3 months? It's that simple. And D, what does this company pay in dividends? If it doesn't pay any dividends in the next 3 months, that disappears. If it pays a dividend in the next 3 months, that's going to affect this valuation. All right. So what you need to know is which way it goes. So strike price for an option, that's that 210 on the call or the 170 on the put. That's going to determine the value of the options. So we can go back and you can just see it. It's kind of somewhat intuitive. So if the strike price is really low, you could buy Apple for 160 and it's currently trading for 190. Look at that price, 34 bucks. That's really expensive. What happens as the strike price rises to the value of the option? What are you noticing? It's falling pretty dramatically, isn't it? Would you rather buy Apple for 160 or for 220? I'd rather have an option buy for 160, but that's pretty expensive. Would you buy an option to buy Apple for 290? It's only 1 penny. Could you actually get 1 penny? Probably not. That's probably just rounding because there's some that are zero. But you notice as the strike price on a call rises, the price of the option falls. And what do you think it is on the put? Would you rather sell Apple for 160 or sell Apple for 240? 240. So what happens to put options as strike prices rise? They rise, right? For call options, the opposite direction, put options. So we notice with the puts, the right to sell option for 50, sell Apple for 50 is worth almost nothing, but the right to sell them for 245, that's worth quite a bit of money. All right. So with strike, with the calls, it's in opposite directions, with puts in the same direction. What do you think about the underlying? What do you think happens? If Apple were trading for 210, what would happen to these call options prices? It would go up, wouldn't they? If Apple's trading for 210, you got an option at 210, that's going to make it much more valuable. What about the put? What happens to the put value if the stock price goes up? It's going to make it worse. All right, so with the strike price, puts go in the same direction with the strike price, calls go in the opposite direction. With the underlying stock, it's the exact opposite. Calls go in the same direction, puts go in opposite directions. So here's the underlying, where's the underlying stock price? Where did I put it? Oh, current stock price. Here, calls, they go in the same direction, puts in the opposite direction. With the strike, calls in the opposite direction, puts in the same direction. And that's the hardest one to kind of keep in mind because the other ones, essentially, they both love it. Both puts and calls love time. More time, more value to the option. We can see that with Apple. So that 220 or that 210 was trading for $2. We change this to December, at 210 is now trading for 6 cents. And it's pretty dramatic because we only have 1 month until December. There's a very low probability Apple's going to be trading for $210 or more. But by next March, yeah, you have much more chance. But it's the exact same thing with the puts. At 170, it's much cheaper. It's not $2, it's only 21 cents. All right. So options love time. What about volatility? What do you think? They both love volatility, right? I can't show you that because I just have Apple. But the more volatility, the higher probability that thing's gonna be at a price you're gonna like. So both time and volatility, more options love it. Now, something on the second exam, we probably won't get this until Tuesday, which means our last team question is going to be the last day of class on options, but you can practice this. You can go look at it. But with time, there's something called time decay. The option price is going to fall just because you move through time. That's called time decay. And time decay is the most dramatic the last 30 days. So usually if you have an option and you want to roll it forward, you're probably going to roll it forward 30 days before expiration, because if you wait after 30 days, that time decay is very, very rapid. So time decay at expiration, time value, we'll talk about time value. I have to show how to calculate time value. But that time value is 0 at expiration because there's no more time left and it declines pretty dramatically. So we'll talk more about that, but time value, more important, the more time you have, more valuable. Volatility, this is the only thing you don't know when you buy the put. You know the strike price, you know the underlying price, you know how much time there is, you know what interest rates are, but you don't know because you know the volatility of Apple stock the last 3 months, but the options trading on volatility the next 3 months. That you don't know. That could change quite dramatically. So volatility is the most important, and it goes in exact